So we are going to continue on here with chapter 9. Holy cow. Chapter 9 focuses on some particular types of tax cuts. Obviously this list is not exhaustive. There are lots of other types of tax cuts, but these are the main ones that are used by individuals. Now you can see we've got a lot of learning objectives here. We've got 9. That last chapter only had 4, so we're making up for it here with 9. But you know, a lot of these, some of these you'll be familiar with, so you may have a point of reference for some of them. First one we're going to talk about is a credit for child and dependent care expenses. This is for when you have a dependent, usually it's a child, but it doesn't have to be just another type of dependent where you have to provide some type of, you have to pay somebody or an organization to help care for them. So there is a tax credit available under certain circumstances for that, so we're going to talk about that credit for child and dependent care expenses. Credit for the elderly or disabled, that's another type of credit. It's kind of I'm not quite sure why they include this in the chapter. It's pretty obscure. It's not, a lot of folks don't really get to take advantage of it, but we'll take a peek at that and what it all means. Education credits. So this is one that most students are familiar with, maybe, or interested in. A couple different types of tax credits for education expenses, and we're talking about higher education expenses. Foreign tax credit. This is where you have paid foreign taxes on income that you also have to report in the U.S. So if you have, say, $1,000, you've got a bank account in England and you were paid the equivalent of $1,000 of interest and you had to pay tax in England on that income. Well, you're also supposed to report that income in the United States. So now you're paying tax in England on the $1,000 and you're paying tax in the United States on the $1,000. You're getting taxed twice on that income. There is a foreign tax credit that helps to mitigate that effect, so we'll go through that as well. Retirement savings contributions credit. There is a credit available to certain individuals as long as they meet income requirements, where if they contribute to a retirement account, they not only maybe will be able to reduce their taxable income through like pre-tax deductions from their paycheck, or they get a deduction, like if they contribute to an IRA, they'll get a deduction for it. They may also be entitled to an additional credit. This is one of those rare areas where you may actually get a double benefit for the same tax for the same activity. So we will look at that. There is a very generous adoption credit as well. So we'll go through the requirements for that. The earned income credit, this is probably the area of this chapter that is the most involved, is the earned income credit. Earned income credit is a credit that is designed for very low income individuals, usually with children. If you have children, the income limits for the earned income credit are much higher. If you don't have children, they're quite low. But this is essentially, it's designed as sort of a refund of Social Security and Medicare taxes that are paid at that level. Because for a lot of low income people, they actually don't pay much in income tax because they don't make enough to pay an income tax, but they're always paying the Social Security and Medicare tax. So this is a credit that's designed to help mitigate the effects of that tax on very low income individuals. And then the premium tax credit under the Affordable Care Act, so this is otherwise known as Obamacare. There are, depending again upon your income, you may qualify for assistance with paying health insurance premiums as long as you buy them through the health insurance marketplace. That benefit can come either in the form of a tax credit at the end of the year, or that tax credit can be spread over the premiums that you're paying. So it can help reduce the premiums that you pay throughout the year. So for example, maybe if you're entitled to a $2,400 credit, premium tax credit, you can take that $2,400 all at once at the end of the year when you file your tax return, or you could spread it out as $200 off of the premium every month that you're paying those premiums. Well, at the end of the year, you have to, the amount of the subsidy is determined at the beginning of the year. Well, oftentimes, your income at the end of the year ends up being different from what you thought it was gonna be at the beginning of the year. So you gotta have to do a reconciliation between did you get enough credit? Maybe you're entitled to additional credit, or maybe you weren't entitled to the credit that you got in the first place, so you have to pay it back. So there's kind of a reconciliation that has to be done as well at the end of the year, and that's the premium tax credit that we're gonna take a look at. If there's anything else I really wanna say. So just to briefly, and I think the introduction goes through this, the difference between, and this is just a reminder, we have deductions and we have credits. Both of those things ultimately reduce tax liability, but they do it in different ways. So a tax deduction, oh, this is a bad one. This is a bad one, I can tell. Let's see. Deductions reduce taxable income. Credits reduce tax. So because deductions reduce taxable income, that deduction is always going to be a percentage. You know, the ultimate tax savings is always going to be a percentage of the actual deduction itself. So for example, if you have a deduction of $1,000, this is $1,000 deduction, and you're in the marginal 22% tax bracket, your tax savings is $220. Okay? A lot of people get these two items confused. I'm sure you guys don't, because you've been in this class long enough. But so that even though the deduction is $1,000, you're not getting $1,000 back. You're getting a percentage based on what bracket you're in. And of course, if you're in a higher bracket, you're going to get more. So if you're in a 37% bracket and you got a $1,000 deduction, you're going to save $370 in taxes. Conversely, if you're a lower tax bracket, say 12%, you're going to save $120 in your tax liability. Right, so that's what the tax savings there. Whereas with a credit, $1,000, if you get a $1,000 tax credit, that reduces your tax by $1,000. So if you owed $2,000 in taxes, or you had a $2,000 tax liability, and you get a $1,000 credit, now you have a $1,000 tax liability. It's dollar for dollar. Whatever that credit is dollar for dollar. Now, the credits, when you calculate the amount of credit, it's not necessarily going to be 100% of whatever your expenditure was. For example, the lifetime learning credit. Lifetime learning credit is a credit up to 20% of $10,000, so up to $2,000. You may have spent $10,000 on education, but the credit itself, so you're not going to get $10,000 back, but you're going to get up to $2,000 back because the credit is a percentage of the expense. How we calculate those credits is what we're going to go through in this chapter, how we get to this amount. But once you get to this credit amount, it reduces your tax dollar for dollar, okay? As opposed to the deduction, which reduces your tax a percentage of what your tax is, right? Usually a credit is going to be more valuable, not always necessarily. But usually, but one of the things that tax professionals will do is make a comparison. So for example, that foreign tax credit, and I think I talked about this when we talked about the Schedule A and taxes that are deductible. Foreign taxes are deductible on the Schedule A. Well, if it's on the Schedule A, it's going to be a deduction. So it's going to reduce a percent if you itemize and all that jazz. If you benefit from it, it's going to reduce your tax by a percentage, whatever your marginal percentage is. If you take the tax credit, it's going to reduce your tax dollar for dollar. But again, there's calculation that's involved in both of those and tax professional will do that calculation to determine which is the better course of action for the tax client. Another difference between with regard to credits, there are two types of credits, and I think I've mentioned this. Let me go grab, I think there's a black one here. There are two different types of credits. There are refundable credits, and there are non-refundable credits. A refundable credit means that if you have a refundable credit, it means you're going to get back money when you didn't even have any tax liability. So if you do the calculation of what your taxes are, and turns out you don't have any tax liability, zero, when you get down to the end. If you have a $2,000 refundable credit, you're getting $2,000 back. Even though you didn't owe it in the first place, even though you didn't pay the $2,000, you had no liability for it, you're still getting the $2,000 back. Refundable credits are extremely valuable. As a result, they are also they also have a lot of fraud associated with them. So refundable credits, the ones, earned income credit is one. Child tax credit has a refundable component to it. And the American Opportunity Credit. Sorry, no, the acronyms. You'll pick up on the acronyms through this chapter. But so these are the three refundable types of credits. That means that, like I said, so you do your taxes and line 16. We're not even talking about whether you prepaid any through withholding or anything like that. Like line 16 is, let's say line 16 is $1,000. We don't know how much you had withheld, right? You may get a refund, even without the refundable credit. You may get a refund if you had $2,000 withheld, you'd get $1,000 back, right? With a refundable credit, it acts like a payment. It's sort of treated like a payment that you made, like extra withholding that you had. So you're going to get it back. So if you have a refundable credit, let's just say you had an EIC of $3,000, you're going to get $2,000 back. That's assuming you didn't even pay anything in. Okay? So it can bring you below zero tax liability, a negative tax liability, essentially, is what it comes out to be. Now with a non-refund, any questions about that? Okay. No? Okay. With a non-refundable credit, it can only bring you to zero. It cannot reduce tax liability below zero. This one can, this one can't. So if line 16 for a non-refundable tax credit is $1,000, and you have a non-refundable credit, let's just say you had a lifetime learning credit of $2,000 because you paid $10,000 of educational expenses, and that's the credit that you qualified for, it only brings you to zero. Sorry. You're gonna lose $1,000 of that credit. You don't get credit for that credit in that case. Okay, so it's not as valuable. These are extremely valuable. There's a lot of fraud that goes along with these, and so there's a lot of additional requirements that paid preparers have whenever they have a client that is claiming one of these credits. They have to take some additional steps. Otherwise, if something happens with it and they didn't take those additional steps, like if the client is not entitled to, takes one of these credits but is not entitled to it, if the preparer didn't practice due diligence, they can be subject to a fine for that. I think last I knew it was like $500 per return, sort of thing. So preparers have additional responsibility whenever a client is going to take one of these refundable credits. Okay. Go to the next.